We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is John Lee. He's a chartered financial analyst with 20 years experience in the mining industry and a passion about studying the financial markets. How are you today, John?
Good to see you again, Tom.
Excellent to see you too. So I'd like to start by maybe talking a little bit about your perspective on, let's say, wanting a coal project and the importance of just having power in extreme climates. You know, everybody thinks we're, as a world moving away from coal, but there's this seems to be a theme where when countries are running out of energy, we're going to have to kind of resort back to some of these proven sources of power that have really built the world into what it is.
Tom, coal is somebody nobody talks about, but yet it is a number one performing commodity in 2022. Coal stock has zoomed. And I was looking for coal stocks to invest. They actually somehow changed their name to resource, like the word resources, almost as if they're not feel good about what they produce and what they sell. Tom, I think there's a lot of discussion about moving away from coal and fossil fuels, and it's almost a zeal. Somewhat even it's almost some sort of a zeal. Follow on moving, towards this green energy away from fossil fuel. I was just in Mongolia 4 months ago, and I think there's some countries and there's some places that have a place for high percentage renewables. Developed countries that have the financial capability and has the know-how. But then at the same time, in some parts of the world, like in Africa or in Mongolia, for example, they don't have the financial resources available to develop renewable energies. And some of the battery technology is still, while it's maturing, still not at a place to complement these renewables to improve the utilization rate. So in the end, and then I think there's a lot of talk about uranium as well. There's a lot of uranium bulls out there. I'm personally not one of them, because if you look at the number of uranium plants that are this is IAEA statistics, the number of uranium plants is actually going down. And it takes somewhat about 10 years and $10 billion to build a gigawatt nuclear plant. Mm-hmm. And whereas it takes maybe a 20% amount of time and money to build something equivalent in coal. So going back to what you were saying is there's not a more proven, cheaper, safer, faster method to produce baseload energy than thermal coal. So I mean, we have a coal project in Mongolia, and in the winters minus 35. When the turbines froze, when the sun doesn't shine, and if the power stopped flowing, people die. And that's really the bottom line, Tom. Mm-hmm.
Well, yeah, it's you make a good point about let's say the more developed countries having the ability to have these more, let's say, sophisticated forms of power generation. But in the cases of uranium, where we have the ability, or we're starting to see the ability of these smaller reactors to be built, I think that provides more potential for the uranium space. But as you say, when we're thinking about how developed countries versus, let's say, less developed countries like Africa, Mongolia, they're going to be burning whatever they can to get their energy and their populations to the same status that the rest of the world enjoys, right?
Well, Tom, I'd rather live 5 kilometers from a coal plant than a uranium plant. That's just my personal preference. And secondly, you can build a 500, 600 megawatt power plant with 85% utilization, a base load in less than 2 years and about $500 million. And I think third is Tom, if you look at, I talked to a couple of experts about why oil price is so high. It's not so much people are driving per se, or people are flying. If you look at the airline stocks, they're in the dust. It's all about power consumption, energy consumption, electricity consumption. A quick example, Tom, if Isabel digress a little bit, but we're also in the nickel business and study a lot about electric vehicles. If you were to drive an electric vehicle for 10,000 miles a year, which is quite typical of what the United States, and United States per capita consumption of power is around 13,000 kilowatt hour. 10,000 miles per year would add about 2,000 to 3,000 kilowatt hour of power. And this is a time when there's underinvestment in infrastructure. Like people don't, it's just not a sexy business. People don't invest in power. And where are you going to get that additional 20 to 30% of power? That will require building power plants, in dozens starting today. And that's just not a possibility. And that's why you see these blackouts in a lot of places. And that's why I also see, Tom, oil prices are so persistently high, because they had to resort to burning oil and natural gas to produce that baseload power. And that's not as sustainable. And that is not an ideal way to go, because oil is for mobility. It's a bit of a waste to having to burn oil to generate that power. It's just not what it's designed to do, Tom.
Well, and to your point, John, we saw, I believe it was the beginning of last week, California came out and said that they're going to stop selling internal combustion engines by 2035. And yet the same week they said that we don't have the power available because of the hot weather and the demand for air conditioning to be able to charge everybody's electric cars. So, it kind of seems those two themes are really on a collision course.
And further, in Australia, the banks in Australia have stopped financing new auto purchases. The issue with power, which I study quite a bit, utility, it's not only to do with generation of power, but the infrastructure for power transmission, which is also a big issue to have to contend with. Again, going back to this green energy, moving green and away from fossil, I think there's maybe more that meets the eye, because if you look at New York, the city of New York, they're looking to phase out natural gas for heating, for cooking. And you have to start to wonder, why were they even against natural gas, which is one of the cleanest forms of energy? And then, go on a limb, I would say it's more to do with the eye, and maybe it's to do with control, because much talked about digital currency and how that could have a government sort of a grip on your spending, on your patterns, and how you spend and how you save. Well, if the government can transform everything of natural gas and oil to electricity, it's a lot easier to control that grid by turning on and off the switch than having you to have gas, which is mobility, right? And let's see how this plays out, Tom.
So, John, when we're seeing this real push towards ESG and just the green initiative in general, do you see the possibility of a pushback away from this trend towards companies being so focused on these ESG mandates? We've seen energy prices in Europe shoot up so dramatically due to their reliance on solar and wind that isn't always producing the energy that they need. So do you see this ESG shift as being maybe more like a pendulum in these extreme times?
ESG, there's really three elements to it, Tom. There is the environment, and there is social, and there's governance. So let's get the sort of less contentious topics out of the way. In terms of governance, the companies have moved a long way. Used to be, the board of directors, as you see, have very diverse background in finance, environmental, in technical aspects of it, as running a mining company. So I think the government has really come a long way. And if you look at the social aspect, things have changed a lot, Tom, say from 10 or 20 years ago, where you just build a mine, you got a permit, 6 months later, you got the piece of paper, you start digging, the neighbors don't even know about it until then the government always sided with the mining companies, and that's why there's a bit of mining companies have a bit of a bad rap in the past. However, Tom, you see countries like, especially like Mexico and also in Canada, countries, in some certain countries in South America, if you build a mine or if you make too much noise or if you do something that locals don't like, what is legally allowed or regulation permitted or not. Mm-hmm. If they block your road, the police are not likely going to show up, and you have a lot of these. While you have a concerted effort from global environmental conservationists that while it's in good intention, but sometimes they will pick target to go and almost make it an example. So it's not as lopsided or as one-sided before. The locals now, especially the indigenous population, the First Nations, they have a lot of financial resources, legal resources, and they have also a lot of the government support on their side. So if they want to block your road, your mine is going to be stopped, and now it's gravitate much towards what I call the three rules of doing business in mining or for any business in the matter. That's the rule of law, the rule of logic, and the rule of relationship. So no longer the rule of law, as it's written, however, policed by the politicians, is going to govern the running of a mining industry. So I think the social aspect is really improved a long, long way. And if you trip over, if like I said, if you do something that locals don't like, you're not gonna be running a continuous and peaceful operation. Now let's talk about environment. We are moving towards a carbon emission free era. Okay, everybody's talking about 2030, 2050, no more carbon neutral. I don't think there's any doubt in my mind, Tom, in the next 5 to 6, in the next 3 to 5 years, by 2030, everything you buy is going to have that nutritional table. It's what I call it. Not only the country of origin, but the collective sum of the carbon units produced for that product you bought. And the government is doing it on a two-pronged approach, the carrot and the stick. The carrot is billions of subsidies available as dished out by the Biden administration. The rules are quite complex. We haven't seen any money coming out yet, but it has a lot of strings attached to them, right? The elements you produce must not have some components from Russia and from China and elsewhere. And some of the investors we talked to are very adamant about that, and they're very explicit about their investment criteria and mandate. A lot of the funds we talked to in London also has that E.S.G mandate. There's some things that you do. They're like if you dump the tailings in the ocean like they do in Laterize in Indonesia, it's just over. So there's a lot of carrot incentives and investment mandates to go into these green energy sectors, but there's also a stick, and the stick is carbon credits. And I think in Scandinavia or some Norwegian countries recently announced, if your industry exceeded that you're allowed carbon emission credit quota, you're gonna have to pay. Okay, and these prices going up. I think Canada as well. It's not as together, but that framework is the concept is there. The framework is gonna be developed, and before 2030, it will be enforced. And even on an individual personal level, it's not just about corporations complaining. On the individual level, there's some talk about the carbon credit card, and once you see the carbon, well, then if you talk about limit on carbon, then there has to be tracking of carbon, right? That's why I talked about the nutritional table. So, like it or not, it's coming. Do companies like it? I mean, they're for profit, so I think. The issue, Tom, I have is not so much about. I think if everybody's a level playing field, I'm actually okay. I'm for the environment. I've seen the devastation of some of the Asian countries I travel where pollution and yield plans and just run the industry ran amok. So I see that, and some of these environmental damages are not reversible. I think the issue is with compliance and with enforce. You cannot have a mining company like in Canada. It's like California, you have a house that will tell you how you build your furnace. You can do this, you can do that. And yet you have homeless people running on the street, right? And I think that analogy applies to some countries where they don't have these governance, they don't have these rules, but yet they're competing. Say in the case of mining, they produce the same goods, or auto in EVs, or cars, or or in all this industry. So I think there has to be, once rules are written, so and for the common good, but then you got to have that enforcement. Otherwise, people are just not playing on level playing fields, Tom.
Mm-hmm. But
so there will be pushback. But I don't think it's avoidable. It's coming.
Okay. So, John, you also mentioned basically the sanctions on Russian companies exporting their resources, and I've heard you talk about maybe ways kind of getting their commodities out of the country and sold anyway. So explain to us how that works.
Well, it's been a while since we won the program. I actually know oil traders. These sanctions, they don't really work. Mm-hmm. All that happens is you have middlemen that make the difference. So some guy could have boats have different flags, and in Russia, even though it has been sanctioned, but they're still free to do business with some of the Middle Eastern countries, even countries like Turkey, China, and almost resort to barter trade. I will import some nickel from you. I would export some nickel, or I will export some electronics, cell phones, and you give me some oil. But to the middleman, they will buy oil and with a Turkish flag, and then 3 rounds later, they sell it in the open market and make million. Like a middle-sized oil trader, I heard, made over $50 million this year. I don't have a view on sanctions. However, that's just the way it works. Mm-hmm. Yes.
I know I read a book recently called The World for Sale, and it's all about these commodity traders. And it's incredible. Just, to your point, it's incredible the amount of money that they can make just by, creating this arbitrage opportunity between states that have resources and other states that need them. And the way that they get around some of these sanctions or laws is quite interesting. And obviously, we're moving more towards safer and cleaner everything. Yet, when push comes to shove, I think that these resources are going to be needed by countries that are starting to get cold and dark, right?
Unfortunately, Tom, a lot of that natural resources and money, finances, and politics are all tied in together. Mm-hmm. I think the Western world is trying to do a replay of what was in year 2000 of Boris Yeltsin, and I think there's a very strong pushback on that. So it's not so much a war in Ukraine. I think that was just a facade and looking to achieve their objectives, and is retapping into the natural resources of Russia in the sort of the twilight years of Putin to see if they can go, make a go at it. I'm not pro any candidate or pro any countries. That's just kind of the way I see it. Huh? Mm-hmm. And consequently, people are asking me sometimes, when is this going to end? When is the war going to end? My answer to that is, when is the next one going to start? Because there's not going to end until there's a change of regime. And they openly talk about it. This is not some hidden secret or something I conjure up together. And, until they find somebody they can install and to tap into their assets, whether it's natural resources or finances or electronics or technology, it's not going to stop. And Russia, and they're going after some heavyweights. And there's even some discussion about change of regime in China as well. And the press wouldn't go that far unless there's some very, very big power that have given the green light to send a message out. Tom?
Mm-hmm. Yeah, it's again the curse of living in interesting times is I don't think has ever been more present than right now. But of course, it's just going to take time to play out and see what force ends up winning here. John, I'd like to move on a little bit and get your perspective on the silver price. Considering all of the turmoil in the world, the continued growing industrial and dramatic investment demand, what do you think explains the fact that we're almost at a 3-year low in price here? I know it's a brutal question.
I almost gave up on silver analysis because it's not really productive. Mm-hmm. it's first of all, Tom, like silver is a small market. You took on 1 billion ounces a year at around $20 billion. And you know that on a busy day, on a daily volume of COMEX, it could exceed like half of the, like you're talking 200-300 million ounces traded a day. And so, and silver also holds a special place because it's money. And when you have to do money, it's to have then the powers would take in a keen interest. So you have this confluence of all those things happening, which makes the silver price really very difficult to forecast. And men oftentimes are not trading based on the fundamentals. I don't have a call on silver. I think we're largely, and you're asking me why silver is trading at such low prices, even though there's industrial demand and investment demand. If you look at from the investment demand, which runs anywhere from 10 or 20%, or maybe slightly higher, depending on sort of, how you analyze that, because that is really the back of the envelope study. It's mostly a retail market. Because there's not enough silver for the central banks or for the Warren Buffett to go into, and Warren tried and got slapped on the wrist to not go back there again. Mm-hmm. And he even have to preface that he invest in silver not because of inflation. It's almost like a scripted public statement. And so there's just not. It's a retail market for silver on the investment side, and as you know, the world is going through recession. So I don't think there's much discretionary. I don't hear a lot of stackers say, "Hey, I got another 100 ounces of silver recently." And also, I have a dealer in Taiwan that I tap into. There's a lot of silver that's coming out, not being available. And on the industrial side, I would say it's a fairly balanced market based on what I read and what I see. I mean, even though it's being used increasingly in electronics, but because the technology, I think we talked about that, the amount of silver required to go to a solar panel has gone down more than 80%. So there's a lot, because silver still, I mean, it's $20 an ounce versus $3.50 a pound, right? So comparatively speaking, with other base metals, it is trading at a very significant premium. So there's always people that are looking to substitute silver with some other lesser expensive element components. So even though we're moving increasingly into a digital world, the industrial demand, a lot of that's being substituted. So it's not like nickel, Tom, where you see that you see that EV is clearly written on the wall that you're going to need nickel, and you're seeing BHPs and Wailu's. BHP made a $5 billion takeover of Oz Minerals and went up ashore to buy Noront, and people are scrambling for nickel. You're not seeing like Apple, right, going after First Majestic. I mean, it's just not. And they have these mega mines that have produced very stable silver as a byproduct. So I think both on the supply side and the demand side of silver is really sort of a difficult element to analyze. And I think the best forecast for silver is looking at gold. I mean, those two are twin sisters. And if you look at gold, it's antithesis of the dollar. So if you're going to look at, say, what is my forecast for silver, I would say look at the forecast of gold. Mm-hmm. And that will be the forecast of when the dollar is going to top. So that's that's where I look at it. And there's some other ratios where gold and silver come in handy. Is some of the gold to silver ratio, the outperformance of silver will seem to be an indicator that because of a very small and sensitive market, that when silver started to outperform gold, that is an indication that the economy is recovering. And that we're reflating the market. The dollar is near the end of its rally. So that's some of those things will be interesting ratios. But right now, I am not saying, hey, let's go. I think now if you are a long-term holder, buy and hold, your downside maybe is $1.50. Maybe you can get a flash to $11, $12. But these prices we're back to 2005 at $15, $17 an ounce. But for the traders that are saying, we're going to go, like silver is going to go to the moon at $30. Right now, both in silver are firmly below both its 200-day moving average and its 50-day moving average. So technically, it's in a doghouse. Mm-hmm. And you never know how long the market stay irrational longer than you can stay solvent. So, this irrational things about silver can go on still for a while, at least for the next 6 months, as I see.
Mm-hmm. So you mentioned the gold to silver ratio. Is that telling you anything specific right now?
Gold and silver ratio over, historically speaking, has been around 70. That's a sort of a natural equilibrium. Mm-hmm. And has gone to as low as 20 to 50 and during the good times when silver went to $50 back in 2011. I think gold was around 2000, so the ratio is somewhat like 40. But now that ratio is 95, 93. So it's only being sort of surpassed by, I think it was back in 1985 and year 2000 when the ratio was close to 100. And so we're looking to getting to that, quite an extreme level. So that's telling you that there's a lot of fear. There's a lot of fear well, it could be a lot of things. It could be either there's a lot of fear in the market, or it's just a lot of it's just a general discard in the commodity market. But however, I think that the current ratio, while it's high, but the ascent of that pattern, it doesn't seem to be having reached the blow-off phase quite yet. Mm-hmm. So what that tells me is there may be some more additional pain and suffering to come in the general market. That means the dollar could still head higher, and that means the equity market can still go further into a bear territory. Tough to see how, because if you look at the yen, it's trading at $1, 140 yen to $1 because the yield. Carry trade, but a 140 yen to a dollar, that's 35-year plus history, and same with the euro at parity. However, the pendulum can continue to swing until it goes the other direction, the Newton's second law. But right now, the gold to silver ratio is at an extreme based on all historical measures. However, the pattern suggests that the way it's going, it doesn't seem like it's parabolic yet. Shows that maybe we can see a blow off in the next 3 to 6 months, and consequently, Tom, I think that's how I call. I see probably a bottom in gold and silver within the next 3 to 6 months.
Mm-hmm. With the euro and the yen being such large components of the DXY,
yes,
John, does the fact that they're both major exporters affect how high they can actually send the dollar?
Well, if you look at going back to economics 101, the currency is governed by investment demand, or the trade deficit. To sort of move on a layman term, is investment demand and it's actual commerce demand, right? So when you're exporting and importing goods, you're exchanging. So if you're naturally an exporter, your currency will naturally be strengthened. And then there's investment demand, and that's much more yield chasing, which is going to get a bigger interest rate, then investors gravitate towards that in the short term. And that's why every time when there's Fed, that's why everybody's speculating, looking to see what the Fed is going to do, what the ECB is going to do, what the BOJ is going to do. So we're at the point, I believe, that, like I said, if you go to Europe, things are on sale right now. And if you look at some of the emerging countries like Turkey, Colombia, I was there. The Colombia peso is 4,500. It was less than 3,000, not even 2 years ago. So we're very quickly approaching to, I remember year 2000 when things that could be half hotel for $30 a night in emerging countries. We're approaching that sort of territory. Mm-hmm. So therefore, if you look at fundamentally, the dollar is quite overvalued, but it's continued to exhibit that yield differential. So people are chasing yields and forecasting higher interest rates to come. To put it one way, that when the plastic ban goes the other way, snaps, it's going to go like year 2000, right? When the dollar went down big time, and also all these crises in 2009, 2020, that once that climax of the dollar set in, you're going to see quite a big reversal. However, Tom, there's a caveats. There is a concerted effort to prop up the dollar in some sort of a a dubious way, I would just say it lightly. I think that before the dollar to run out of its course, there may be some advent of additional new instrument that will come in. So in a way, that's just called the power that be. It's much easier to control one currency than to control 50. So in the way, they are siphoning the liquidity all into the dollar to facilitate the next phase of the new era. And that will come in the form of either central bank digital currency or some other form. They are working folks are working overtime towards this next phase of the implementation. So, which I think is gonna spell out additional volatilities to come. So, Tom, I would not necessarily bank on the dollar. And I'm not a dollar bear because all the other currencies have been subordinated to the dollar, and the heads of the states are not. They're all sort of one big sort of entity. So, like, I'm not bullish of the euro. I'm not bullish of the pound sterling. I'm not bullish of the Canadian dollar or the Aussie dollar. It's really gone into sort of fiat versus tangibles, and so let's wait and see. I'm not a dollar bear. I don't think the dollar is going to go back to 88 or like it was before. Things are not the same as it was before.
Mm-hmm. When we think about this, what has been called the commodity super cycle, I've had previous guests of the show say that ends up being very good for commodity rich countries like Canada and Australia. So do you, while you're not, let's say, a bull on either of those currencies, does the amount of commodities that come out of both of those countries help them quite significantly in that type of environment?
Tom, it has. Like in 2011, Aussie dollar and Canadian dollar trading almost 20% premium, not at least over 20% premium to the American dollar. I remember Australian dollar was trading at a premium to Canadian dollar. And that's to do with, as we talked about, the export surplus. Unfortunately, currencies today, like commodities, the fundamentals, meaning based on trades, right, have gone to the not to the wayside, but to play a much smaller role, at least in the short term, than the investment demands or the interest rate differentials, or in the sort of the capital money flow. And also keep in mind some of the policies Australia implementing in Canada is anti-investment friendly in allowing foreigners to buy real estate, to make investments, having investment boards to review all these things. So it's just turned off a lot of the capital inflow. I'm not. Well, I mean, Tom, you mentioned about the commodity super cycle. I'm not so sure about that as I was maybe 5 or 10 years ago. And the reason is this, Tom. If you're looking at a simultaneous destruction, demand destruction, and supply disruption. When I said demand destruction, while people are still on two sides of the aisles on the debate on the world population, I am firmly sided with Elon Musk. I think the world is going through a crisis in population. And it's very clear for me to see, because I travel 35 countries. I travel around the world 3 times a year. I see that with my own eyes. Even in Taiwan, the population this year was down 2% from last year. So if you're looking at this pace, and you got some 35% that are over 60, at this pace, the world population will be half of what they were 20, like in a generation. Okay, Tom. Mm-hmm. And then if you think about, okay, who's going to buy copper, right? Who even population in China, according, like, why would you believe the Chinese population statistics if you don't believe their GDP numbers or inflation numbers? Mm-hmm. And there are some very credible analysts that have pegged world China population by down 20% from what they officially say. They maybe have barely over 1 billion people, and at this rate, the world population go down 30% within 50% in a generation. Would you still be a commodity bull? And that's why you've got to be selective about some specialty metals. that fit into the narrative of electrification, that has a new use in life, not just like a iron ore that can build a steel, or nickel used to be just utensils, right? There has to be a new way, a form of which those metals would be utilized with new applications. But in general, I am not, even oil, there's talk about peak oil, and I'm more of a macro guy, but in terms of commodity, I am not as a super commodity bull as I was. However, I'm talking demand side, but on the supply side as well. I think, Tom, it's ill-advised right now I look at some of my peers in the mining industry that are doing the traditional 70-30 debt to equity financing and putting a mine into production. Tom, that is suicidal. I will tell you that. Like we lost the rod drilling. It took 6 months to get that part from China, and not just throw out a complete drill program into the havoc. And you're looking to put $1 billion field of mine, of which you have all these contingencies on your debt and mezzanine and royalty packages. And I think as a mining CEO, even though we're a small outfit, I think everybody is looking into how can I sort of, nobody's just like, pounding on their chest and saying, we got to expand, and everybody's quality jurisdictions. I don't want to go somewhere, have COVID restrictions or people going on strike. I want to make sure the logistics, like even for silver, like something you talked about, the transportation of silver went up like $1. And you're talking something that's very, very small. So I think logistics and making sure permitting, and government is having second thought, like having issues on permitting grant. Not so much they have a pushback, but just taken 3 times as long. So going back to what I was saying is you have a demand destruction and you have a supply disruption. And now how is that going to play out? It's tough to say, but if commodities go up, I think the upside is more than the downside. And the reason is every time you have disruption, you have less liquidity. Like if you go to South America, things are just more expensive, right? Mm-hmm. And so I think commodity will go up not because there's more demand, but it's just not, the logistics are just not as fluid as it was before. It's just going to cost you more to buy the things you want because it's just not as much available per se, Tom.
So of course, John, since the last time we spoke, we saw the kind of famous nickel squeeze there. And I want to kind of get your take on how you saw that and how you see it kind of affecting the market now. So has it really affected how producers deal with that market in any material way? Are they weary of the LME now and trading outside of that exchange? You
referenced 2 points that are somewhat separate. So let me address the second point on the nickel mining first. I don't think this is something I've never seen before, where the mining companies are mining nickel not at a profit, not at a loss, maybe at a loss. Like if you look at Vale's nickel production, they went down 20% year over year. That being flat in the last 10 years, and it really go down the cliff in the last couple of years. So at the current nickel prices, they're not making money, Tom. That's just first of all, get this out of the way. Yet, you have guys are bidding for nickel, especially nickel sulfide project, because the carbon emission is 1/100. It's 1% of the nickel laterite. Because the method extraction is HPAL with acid and temperature, and the power source in Indonesia, which is coal-fired. So it's a strange dichotomy where even though you're not mining this thing for profit, but why are you hunting for these assets? You have Australian come ashore to Canada bidding up Noron by fivefold. And you have, so people are obviously what these are, and the traders, like we got 10 companies are knocking on our door. Half of them are unsolicited. And we're 3 years from production for our nickel project in Manitoba. So something is missing, right? Something is missing. Something is missing. The reason is, I believe, Tom, they're looking forward. They can see both sides they can see the bid, they can see the ask. So clearly you have a lot of guys like Elon Musk and GMs and Fords and Volkswagens. These guys are willing to commit long-term contract, 5-year, 10-year, maybe at spot, premium to spot. So I believe that is what's happening, and because there's the market is so tight in nickel that these end users cannot find enough nickel in the short term. Then they're going out 5 to 10 years from now. And also the likes of Elon, even though he's a car manufacturer, right? Why would he care bad nickel going to the bad batteries? But he understood that if nickel doesn't show up in the battery door, the battery doesn't show up in Tesla's door, then you're looking at hundreds of billions. Like the damage is incalculable. I think that's the first point. So therefore, I don't think the mining companies are reacting to what's happening with the LME itself, but they're seeing the train, they're seeing the freight coming down in demand. And so that's the first point. Secondly, LME is a very interesting. I mean, Tom, just for your audience, I've been in the nickel industry for more than 13 years. I have bought and sold as a junior mining CEO more nickel projects than anybody else. And I'm 10 years early, and so I know nickel very well. Nickel metals trade, LME account for only about 20%. Maybe even not at that. And the reason is LME, you're talking class 1 nickel, 99.6%. And they're nickel pellets, nickel plates, and they're the purest form of nickel. However, 60-70% of nickel go to stainless steel and alloys. And these alloys, they don't need 99.6% nickel. So what you have is they chuck the ore in from Indonesia at a 1 or 2% nickel laterite. As you know, the nickel pig iron. They would literally blend with iron. They put it in a furnace. That's the dirtiest possible. You're literally burning everything in that, whatever that's in there. They're chucking it, right? And then they get you that nickel anywhere from 5 to 15, 20% at the most. And then that is not good enough, okay? So there's all the impurities, there's all the junks, whatever, in those metals that you use for piping or even utensils. And there's different classes of stainless steel that you use for nickel, but I digress. So the point is that LME trades only around 20% of all the nickels that change hands. Kind of like uranium, but people don't like the end users, Tom, the dynamics, quite interesting. They never want to go through the LME because LME inventory, 50, 100,000 tons, is not even enough to feed half a year worth of production of Tesla. Okay, so if you go to LME, like that is your absolute last resort, because if you raid the LME, like the Palladium guys, they raided the ETF and they raided the COMEX because the Volkswagen diesel scandal, and they rid of the platinum diesel cars. So if they start raiding the LME, unfortunately there's no nickel ETF, then you're gonna see that nickel going up big time. Now, that's resort to your first point on what happened in March. When nickel price went from $10 to $50 a pound in the span of less than 3 days. And that halted the LME. And they actually rolled back some of the trades that cost $1 billion lawsuit right now. This is something that I thought I've seen all I've needed to see in 22 years in the resource industry. I've never seen, and this is not like rare earth. This is a base metal, $5 billion, it's $50 billion a year worth of metals changing hands. And what you have there, Tom, I think it's a combination of physical tightness plus speculators. When Elon Musk 2 years ago said buy as much, mine as much as you want, I think that really draw the speculators' interest. And then technically, nickel traded between $5 to $10 a pound for the last 15 years, and in that trading band. So people make billions of dollars, right? Traders love that trade. Buy at 5, sell at 10 is a no-brainer until it went to 10 and a half. It went to 11. 11 soon to 12. 12 soon to 15. 15 go to 20. After the 20, it's like, Tom, $20 nickel is like $50 silver. Okay, there's nothing. It's uncharted. And then it went from 20 to 50 in the span of like a day. Mm-hmm. And LME market was halted. We can just talk briefly about LME is owned by the Hong Kong Stock Exchange. Hong Kong Stock has a very close relationship with the Chinese government. And the largest nickel producer in Indonesia, and probably the largest, the same size of Vale, is shorting the nickel market. And he was thinking, but he cannot supply that nickel from Indonesia because it's not compatible. So then eventually he got out of the trades. There's a lot of schemes to help him out, like in the nickel market for certain players, the limit up, limit down, and you can actually stay with your contract without rollover. So Tom, that's something that's absolutely unprecedented. You don't even need to roll over when your futures expire, but nonetheless, the nickel is what it was before the run-up started, and that's why I've told to a few in a few other shows that nickel right now presents the absolute best entry point you could ever hope for, because the market broke out of a 15-year consolidation. It went berserk, fivefold. I mean, I don't think there's any question that people cannot just attribute that to all speculation. And then now it's resting on a big time support. And the part is much about EV, right? We can talk about EV, but EV on a very conservative estimate could potentially double the demand for nickel in the next 7 years. And where is that nickel coming from? When nickel production is down 4% from the year prior. Then the last point is, if you look at who is on the long side of nickel, I think that's also quite illuminating. It was not Citadel. It was not just a hedge fund house. The guys on the long side are Goldman Sachs and Volkswagen. So, I mean, these are sticky buyers. And so, I think as the demand gradually pick up, I am a believer. I believe that what will happen is kind of like the cobalt market in 2018 when cobalt went from around 8 to 40. And also the palladium market when palladium went from 800 in 2018 to about 2,800. That first of all, the users, consumers, they're going to scramble and go directly to the mining companies, and also go some traders, a bit of the novice traders that will give it to them. But over time, the tightness of nickel is going to show, and the people are they're going to start piggybacking on these LME inventories, and then the inflection point is going to come. And you can quite easily see nickel go past 12, 15 to 20 to 30s. I think that's probably going to be the equilibrium point at around $30 a pound, where the substitution happens. You're not going to see a spoon out of nickel anymore, and then that EV penetration, EV battery nickel penetration, is going to go from currently around 7 to 8% to around 20 to 30% as a total share of the nickel supply. I think that's probably going to be the equilibrium point at around $20 to $30 nickel, 3 times where we are right now. And then what you're going to see is probably half of your EV cars are in nickel, the highest performance battery cars, because right now you got about 100 pounds that go into a EV, 100 pounds of nickel that goes into a battery for Tesla Model 3 or Plate S, maybe 150 pounds. And at $10 nickel is $1,500. Okay, so it's not the end of the world. Like, you will pay for carbon trim or door seal $3,000 for that for a Lamborghini. So eventually, I don't think that $3,000 battery, $3,000 with a nickel in a battery up from $1,000 it's going to make that. It's not going to kill the nickel in battery per se. Mm-hmm. It's just going to be a lot more specialized in the higher tier nickel. Mm-hmm. So that's going to modulate the nickel demand. But you're not going to have 40 million cars made out 40% penetration, all made out of nickel, and that's just going to move the guys away from nickel, just like the guys did move away from cobalt. Mm-hmm. It's a long-winded answer, Tom, but it's a loaded question. Yes.
Yeah, well, there's so many things, again, as usual, that we have to take into account here. John, are the major auto manufacturers kind of the biggest investors, the biggest players in this space at the moment, trying to secure supply for their cars?
Yes. Elon started the trend 2 years ago, so he was ahead of the pack. And Elon, the answer is yes. We're also being approached by some of the largest auto manufacturers out of the blue, just call us up to say, excuse me, can I speak to somebody at Fly Nickel, please? And I am the top 3 auto manufacturer in the world. So, okay. And they're looking for nickel 5 years out. And so which means, as I mentioned to you, they've already gone to the BHPs, the Trafigura, the Glencores, the Vales. I just did another interview. I don't have the stats in front of me, but Elon's a very smart guy because he is faced with a dilemma. He understood the difference between paper nickel and physical nickel, kind of like the paper silver and the physical silver. So he didn't just go to a trader and say, he didn't just take the word from the LGs or the Panasonic. and he didn't just go to a trader, right? He didn't just buy the paper contract from the LME. He actually sourced it directly from Vale and from Indonesia. I analyzed the sort of the Tesla auto demand, and I had an hour and a half conversation on just nickel. It's my belief that Vale is given all it could to a Tesla already. And the reason I said that is, if you look at Vale's annual production of nickel, is around 350 million pounds. I would say probably half of that is reserved on this conservative number to the Mitsuis, to some of their old-time legacy customers. So they really only have about 20 to 30% of that available nickel. And they have to sacrifice, some of the lesser guys that they don't care as much about, even though they're long-term customers. So so you're looking at something around 40, 50 million pounds of nickel that Elon had bought, which is around half a million auto, 500,000 EVs. So that's what Elon needed today. So I think that Vale is gone. I think BHP is gone. Otherwise, BHP would not have gone up to Wailu and BHP go to Canada. So there's really not all the nickel sulfides. I don't think there's a whole lot that's going around. And Tom, what is your question one more time?
If the auto manufacturers were,
right,
the biggest source of demand here.
Right. Then you have the GMs, they're saying, oh, no problem. We are good. They tell the investors. My belief is they're going after paper nickel. And when push comes to the shove, doesn't matter which guy that got the raw end of the stick, somebody need to come out with the nickel. And that will be major fireworks when the musical chair stops. And not just one person is going to end up without a chair. You're going to have a lot of guys without a chair, because I told you already, all the major, you can count the number of nickel producers out of two hands. I think all of them is all that nickel spoken for. Nickel right now is around 7% on the EV batteries, 7% of the nickel demand. So it's not a lot. However, Tom, when you are entering into a balanced, long-term established market, and you're a new kid on the block and you are pricing sensitive, and that's why the disruption happened, right? Every percentage of the extra demand coming from the EV market is going to cause problems. So unfortunately, I think a lot of the nickel auto guys, they thought they have the nickel, but they don't, and they're going to leave heartbroken. And fortunately, there's the technology, LFP, lithium phosphate, iron batteries. So that could displace some of the nickel batteries, but the two are not created equal. And that's what it's kind of like Volkswagen versus Lamborghini. If you want the best, the quickest, the highest charge, the biggest acceleration, you have to go with MNC 811, which is 80% nickel and 10% cobalt and 10% manganese. So I think LFP is actually probably going to save the day for nickel. And you're going to see some very interesting development. I would say maybe not in the next 6 months, as the world is going through a bit of a correction and a recession. But soon as that there is a bit of enthusiasm and life that come into the market, that the $10 nickel right now is simply not sustainable. This is a market I know a lot better than silver, because there's no above ground inventory. The supply is down year over year. You're not going to see more nickel coming out of the ground. Laterite production is down. As you know, there's been a bit disappointment, and a lot of guys moving away. And then sulfide production has been down for the last 10 years. And then you got the EV, it's not going away. And the good thing about nickel is you have the government that's pro, right? They're pro nickel, not like silver, where they're anti hard money. And then so they're not going to interfere with you in the futures market. And if you look at some of the nickel players that shorted the market one time, they got burned. And also, one more thing, Tom, the guy that shorted billions of dollars nickel in March 2020, he was long nickel in 2018. So he's not bearish on nickel. He just got caught in the end, the heat of the moment. And nickel is something that the Chinese know well, and you can get into a physical hoarding scenario as well, like the Chinese do with copper. So a very interesting dynamics. I think nickel is a clear winner. It's one of the metals that I'm most bullish on.
Excellent, John. Well, that was a pretty wide-ranging conversation there on silver, nickel, some macro stuff. Is there anything else you want to touch on before we wrap up here?
Yeah, Tom, we are in a once generation scenario. Tom, there's been a lot of discussion, like the Doug Casey's, that interest rate is going to go up. The interest rate is interest rate has stayed as long as like 0% for what, 5 to 7 years. Everybody's scratching, right? There's all the inflation numbers are made up, 2 to 3% when inflation is running around 5 to 10% a year for a long time. I believe we're going through a transformation that we haven't seen, not even in a generation, maybe in 3 generations. That we were being on a debt binge by design. 0% interest rate was not natural, and that was for the purpose to get the crowd hooked onto debt. And now the guys that devised the schema is looking to come home to roost. So what we're looking at, I believe, and I could be wrong, I'm hoping not wrong, that the 10-year has broken out of its 42-year bear market, the yield. Mm-hmm. So you're looking at the yield going from 20% for the 10-year to 2.5%. Now the yield is broken out to 3%. That is a 40-year technical breakout. And that yield, and right now the mortgage is already a 30-year at 5 to 6%. Before said and done, Tom, I'm one of the ones that probably stick out my neck out, and I never imagined I'll say this, is I can see 30-year approach 6%, which is double of where we are. And you can see the mortgage upwards of 8 to 10%. And that is gonna dent, to say the mild, crumble the world economy. And that will fit into the storyline, and it's not made up, where some of the guys are saying the World Economic Council is own nothing and be happy. And there's no better way to do that, to drain your 401k. And the guys that are in Treasury is going to be crushed. I mean, many of the times, Tom, they're bidding Treasury at 20% of face value. Like, if you hold your Treasury at redemption, you lose 20% of your money. I mean, that's something like I can never make out of it. So I see quite a grim picture going forward. And then if you think about at not even 6%, at a 5-year, at a 5% 10-year yield, that means that the company is going to pay 3 times more dividend than they're paying right now, just to keep that current valuation. So if they can't do that, which they obviously can, that means that their price is going to go half or even more, because the PE ratio is going to go down with higher yield, because yield is risk-free, Tom. I'm not sure if you get what I'm saying. So what I'm saying is the Treasury is going to go down, the equity market is going to go down, and interest rate is going to go up. And right now, I think what we're looking for is wealth preservation. It's not how can I make more money? It's how can I preserve my money? The good thing about gold and silver, so in this scenario, what can I do? Gold and silver. For the first time in 10 years, I am buying physicals. They could go another 10% lower, but you never know. I think it's about wealth preservation. And another thing about gold and silver is I think the gold and silver will bottom before the dollar tops. I think there's some signs that there's quite a bit of resistance in going down further, like the euro. We'll see whether it can have another breakdown. But even if we do so, you're looking at 1,600. And then if you look at the dollar, Tom, one last point. If you look at the dollar, last time the dollar was this high was year 2000. Gold was 250. So my point is, while you're speculating or you're guessing the dollar is going to go up or euro is going to go down, the wealth, the store wealth, gold is exactly where it should be, given how high the dollar is. In fact, I'm not surprised gold didn't go down further, right? Mm-hmm. So right now it's all about wealth preservation, and we're going to begin some really, really choppy rise. I don't know how it's going to pan out, and there's going to be pushback on higher interest rates. You're going to get pushback from industries and companies and CalPERS and 401ks and RSPs, because these guys they're not listening, right? They are doing whatever they want, and whether they're going to be successful in their schema yet to be seen. But it's a well planned, it's a multi-generation plan they have put in place, and they are executing the plans being executed, and all the debt binge was for a reason. It's not natural. And then another point is about this cryptos thing. I've also done my research, and I firmly believe that it's my belief that the cryptos created by the Fed, and it was to siphon money away from the real assets like gold and silver and even S&P, and provide training for the eventual digital currency by central banks to come. So I think that and I'm going on a limb that's going to end it like the Dutch tulip. Maybe not this year or next year, but it will be before the rollout of the central bank digital currency. Ask yourself, just last point, Tom, why would all the mainstream media talk about cryptos when it's competing with national fiats? They don't talk about gold. And secondly, I do a lot of hiring as a junior mining company. I don't know anybody. I've interviewed maybe 3 dozen. None of them own stocks, Tom. Anybody under 40, they don't own stocks. Mm-hmm. And they own cryptos. And so it was quite a bit surprising to hear that there's not any financial sort of awareness into what's happening. And you ask yourself, why is this happening, right? It has to be a concerted effort to effect its end results. And again, all tied back into the own nothing and be happy by 2030. That's just one dimension of where I see things. You can always find me on Twitter. Google Twitter, search for John Lee at Battery Metals, and we touch on a lot of topics coming from my heart, and hopefully it'll be helpful for your audience. Take it for what it's worth, because it's free.
Absolutely, John. Well, I really appreciate you sharing your perspective on all of these different topics with us, and I'm sure people will find use in it. Thanks so much, John. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.